In this video, I'm about to warn you about the dangers of the stock market. Hey, welcome back YouTube. My name is Mike Swartz. Today, I'm going to share with you guys a few things that you need to know about the stock market. Now, I don't want to panic you and say the stock market's going to crash tomorrow, but the stock market is in for some trouble. I've been saying that for some time, so take it with a grain of salt. What I'm going to share with you guys are my opinions, but I think you guys are going to be pleasantly surprised with what I'm going to share with you guys today. I'm not just going to show you a price chart and say, oh, look, we had this candlestick pattern here. I'm going to go a little bit deeper today, so you want to pay attention. Stay tuned to the end. And if you guys like today's content, do me a favor. Leave a comment down below. Say, hey, Mike, I like this format. And if you guys want to join my live streams where I stream live, you guys can watch me take trades in real time, ask me questions, get feedback, and share as a community, then you can hit the subscribe button, turn the bell notifications, and I stream live Monday through Thursday at 8:45 p.m. during the Asia session. All right, so let's jump into a clip. I'm going to share with you guys a clip from Cathie Wood and what she said about the employment numbers, because on Friday we had the non-farm payrolls, and there was something that I picked up on. Actually, another trader said, hey, look at this. And I started looking at it and I couldn't figure out why it was acting the way it is. But after you listen to Cathie's interview, we're going to then go back and look at the charts, and then you might have an aha moment, that little light bulb click off inside our head.
Employment report. Non-farm payroll employment was 850,000, an increase. The expectation was 720,000. So that's good. The biggest increases were in leisure, hospitality, as well as state and local governments. Those were the two biggest sources of employment growth. But there were a few weak spots, again, that I don't think many commentators have picked up on. They did pick up on the first one. The unemployment rate did tick up from 5.8% to 5.9%.
So the first one, as Cathie mentions, is the unemployment rate. Now, I think most of us saw the unemployment rate actually tick up. That was one of the first things that I was able to pick out. And it went from 5.8 to 5.9. Now, the expectations were that the unemployment rate was going to drop from 5.8 to 5.7. So let's listen to what else Cathie has to say.
What they did not pick up is that household employment, which is not the same as non-farm payroll employment. In fact, the survey size for household is much larger, and it includes a disproportionate number of small businesses, small and medium businesses, unlike non-farm payroll. It actually fell 17,000.
Did you catch what Cathie just said? Fell by 17,000. Kind of funny. And what I'm going to share with you guys here in just a few moments, after we listen to a few more words from Cathie, is going to make a lot more sense. This is the one thing I did not catch. And, I did catch it on the chart. However, I couldn't understand why the chart was moving the way it is, but now I understand. So let's listen to a little bit more of what Cathie has to say.
So it's not consistent and with the headline news, and it often is a leading indicator of changes because small businesses tend to react very quickly to less than good news.
All right, Cathie Wood, what I took out of that clip was she said small businesses act quicker to non-favorable news events or changes in the market. Think about it. A bigger company has a harder time, really changing the process. Where smaller companies, they can react to things a lot different, a lot quicker. So does that mean the market is in the midst of changing as we speak? Well, this chart I'm going to share with you guys right now might open your eyes a bit. So here's a chart of the Russell 2000 futures contract. Now this is on Friday. So I want you guys to go back and look at the S&P. Actually, we'll look at the S&P here in a minute. But the S&P, the NASDAQ, the Dow, they were all to the moon essentially. So if we look at the S&P real quick, all right, here's a chart of the MES, which is the S&P 500. Look at this chart rallying up. This is non-farm payroll, the same exact day. All right, S&P 500, the Russell 2000. Now the Russell 2000 is comprised of smaller companies. And, one of our traders basically alerted me to this on Friday. I said, wow, look at the Russell. It's down 1%. I looked at the chart. I was like, wow, that's crazy. I really couldn't wrap my head around why the Russell 2000 was down so much more in comparison. Now, I have another little treat for you, a chart that I have never seen before that will give us a glimpse into some other statistics that you really want to pay attention to. I thought it was really cool. So let's look at that chart too, and then we're going to wrap everything up. I want to go back and show you guys in past times how the market has reacted and how the Russell has kind of led the way a bit.
So firstly, I want to show you this chart. This chart is courtesy of Jason Geppert of Sentiment Trader, which I think is a very fascinating and a crazy chart for us to actually consider. So what this chart is showing to us is that the ratio of profitable money-making companies has fallen dramatically against companies that are non-profitable or non-money making. So what this chart is potentially showing to us is that potentially more non-money making companies, more non-profitable companies than there are profitable companies. And here's something very interesting about this chart. Notice that the last time this ratio fell so dramatically was back in 2007, 2008, and we all know what happened after that. So notice the last time this ratio was so low, the ratio of money-making versus non-money-making companies, what fell so dramatically low was back in 2008. When you can see from that chart, that was the last time that this ratio fell to such a low level, and look what happened afterwards. As you can see, then the market dropped by about 50%. The stock market entered a bear market, essentially.
Wow, that chart Alessio just shared with us was amazing. I've never before seen that chart, but wow, what an eye-opening. So that chart was essentially showing us that there's more companies in the S&P 500 not profitable than there are that are profitable, which is a contrast from the narrative that's being spun to us right now, right? Everything's great, which leads me to another point. Is the market buying the rumor, meaning the fact that we're going to blow out Q2 earnings, which I do think Q2 earnings are going to be very good, because think about it, we're comparing them to Q2 last year. So of course the numbers are going to seem extremely good. But what about moving forward? And what about the technical aspect of the charts right here in front of us? So if we look at a chart of the ES, which represents the S&P 500, just over the past couple days, we've had 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 up days with only one down day. And this down day was very, very small. It was very, very muted. And when we look in terms of percentages, not to say we can't go higher because we had like an 8-point-something% rally back in April, this move right up here, but we've essentially rallied in nine bars. We've rallied 219 points, it says, which that 9 bars must be incorrect how it's counted because it's 10 bars. But still, in 10 bars, we've rallied 5.31%, give or take a couple, 0.1, 0.2% or so. Because I might not be dead on the bottom or the top of the candle, but relatively close. Either way you look at it, 5% is on the upper end of what we would expect for a rotation in the market. And the fact that we have not had a down candle also starts to be an eye opener. Now, if I just look at from my bias indicator right here and look at from the high up here, we're about 128 points away from that level on the daily chart. That starts to get to that level where it's like, really? We can get higher, no doubt about it, because if we look over here, we're up quite a bit right over here at about 126 points right here when the market, had this little pullback. Then we rallied up a couple more times before giving up almost a 5% pullback or so right up in this level here. Now, I'm not necessarily saying the market's going to crash just yet, because again, the stock market crash is more of a process than a one-day event when the market starts to roll over into a bear market. Now we come back and we look at the Russell 2000 and we put this onto a daily chart. The chart looks a little bit different, right? We've been hanging around these highs for a while and we're not really breaking to the top side yet, right? Doesn't mean we won't flip around and, make one more run up, but this looks a lot weaker and looks like it could potentially start to roll down. Is that going to lead us lower? All right, so here we are. We're looking at a chart of the Russell 2000. And I don't have data on NinjaTrader going back that far, but here's July of 07. July of 07, the Russell 2000 put its high in. And then you can see the financial crisis collapse down here on the Russell, right around this area over here. So the Russell 2000 put its high in almost a year ahead of time. And that would make sense with some of the earnings for maybe 2022 when they start getting looked at and compared to this year. Maybe it's 2022 before we really get the deep, nasty, stock market sell-off. Now, when we compare this to the S&P 500, and we look relatively the same time frame, let me see if I can zoom this out a little bit. Let me make sure I'm on the right time. This is, all right, this is, ooh, I don't want to do that. This is that same high that Russell put in. You can see the S&P came down and actually made a new high. And then when we scroll out, we finally fell off the cliff. Way over here. Let me see if I can zoom this out a little bit so we can kind of compare apples to apples. All right, so here's where the financial crisis happened. The S&P put a high in here, came down, rebounded to new all-time highs once again. And when we come back and we compare that to this chart right here, Russell 2000 put its high in. It failed to come back and take out the high, and then started to make this little downturn, and then the big nasty downturn turned a little bit later. So is it really that hard to believe that we could potentially get a 5 to 10% correction this year? I don't think so. I think we can start to get the correction going, and I think in 2022 that bear market is really going to get underway at that point. And again, 5 to 10% correction is normal in the stock market. Now, do me a favor, if you guys enjoyed the way I laid out today's video, please give it a thumbs up, leave me a comment so I can get the feedback if you guys like this type of video or not. And if you guys want to join me during my live streams where I day trade the Asia session, you can simply click the subscribe button, turn on the bell notifications. That way YouTube will notify you. And if you don't have trust in YouTube to notify you, which I did have a problem last week with a trader that actually emailed me, I had to send him the link. You can simply join my email list down below where it says join live streams. Click on that link and you'll be notified via email half hour to an hour before I go live each night. Like always, I hope you guys enjoyed today's video. Till next time, good luck and good trading.